Welcome to JM Financial Mutual Fund's Equity Outlook. In this short video, we would take a look at how different economic and market factors behaved in the recent past. We would also look at our view on the Indian equity markets, which may in turn impact the positioning of our schemes. Markets have turned negative in October. Recent geopolitical tensions in the Middle East and fear about the election outcomes were some of the reasons. The Nifty 50 TRI was down 2.7%, while the Nifty 150 mid-cap was down 3.8% and the small-cap index was down 1.7%. There was a general sense of nervousness and fear, and many open positions in the market were cut, indicating that the bullish quotient in the market was reducing. Sector-wise, realty, FMCG and auto were the top-performing sectors, whereas PSU Bank, metals and pharma were the laggards. A time correction has already been underway in large caps, while the recent volatility has pulled back mid caps and small caps as well. FIIs remain net sellers for the month of October. Net FII outflows were rupees 24,547 crores. DIIs bought stocks worth rupees 28,254 crores, whereas mutual funds were net buyers worth rupees 13,878 crores. Global indices declined in the month of October. Dow Jones and Nasdaq were down by 1.4% and 2.8% respectively, and Financial Times Stock Exchange 100 or the FTSE 100 was down by 3.8%. The Indian Volatility Index or the India VIX saw an increase in October. It was at 11.83 compared to 11.45 in the previous month, up by 3.3%. The Chicago Board of Exchange Volatility Index also saw an increase in the month of October and was at 18.14 as against 17.52 in the previous month, an increase of 3.5%. From India's standpoint, crude oil prices going up sharply are a significant risk. Global slowdown could also emerge into a bigger risk. The US fiscal deficit is likely to increase and raise yields globally. This could reduce liquidity globally as US interest rates rise, moving US dollars back to the US. Further, the strong growth momentum in the US economy may prompt the Federal Reserve to increase rates. Higher cost of borrowings will eventually slow down growth. China is also going through its own set of issues: demographics, real estate leverage, and a sharp slowdown in exports. Global interest in China as a trade partner is declining, and hence we could see excess capacity that China has to be deflationary. We're seeing some pressure coming through in pharma intermediates, pesticides, and metals. China's manufacturing base is significant, and countries can protect themselves from potential dumping only by having trade barriers. While inflation remains a potential risk in the short term, the seeds of deflation have been sown by China and America's interest rate regime. India's external trade has been impacted for several quarters now as destocking and weakness in global demand have played out. India's potential is positive given its labour pool and a pro-business stance that the government has portrayed. As to how much that translates into business is yet to be seen. On the domestic front, we are witnessing renewed confidence in infrastructure led primarily by government spending. The follow-up investment from the private sector is yet to take place and come with a lag. Announcements of capacity expansion have started, but actual follow-through in terms of capital expenditure is yet to take place. It is expected that the markets may become more sensitive to valuations as growth becomes patchy, if at all. Hence, there is a conscious shifting out of expensive small and mid caps to more reasonably valued large caps in our portfolios. A diversified exposure across stocks and sectors are being maintained by us. As regards opportunities, it is seen that small and mid-cap companies offer promising growth, but current valuations and a tightening liquidity scenario makes us more cautious. FPI selling down has made some of the large-cap names attractive. Higher volatility in equity markets is anticipated, largely because of global uncertainties. Further, a drop in sentiment, both domestically and globally, coupled with higher interest rates, may prompt investors to sell down equities, pressuring performance in the short to medium term. The maturity of the Indian domestic investor could be tested in the near future. Should domestic money, by which we mean retail plus mutual funds, and employee provident fund organization or EPFO flows come through, then we could tide over the volatile market. Investors will need to be cautious in the current environment as increase in global volatility due to the Middle East situation, Russia-Ukraine war, and potential slowdown in the US could play out. Raising liquidity levels may be a prudent way to tide over the current situation. India's long-term macro and growth prospects are good, but a balance between the short-term volatility and long-term growth prospects is needed.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.